All right, everybody, welcome into another edition of the 401 Conversations podcast. This week, we're going to demystify 401k plan fees and fee structures. Thank you, everybody, for joining me today. My name is Mike Neely. I am the host of the 401 Conversations podcast. I'm the investment consultant and owner here at Equity 401k Consultants. And as I mentioned in the introduction today, we are going to talk about 401k plan fees and 401k plan fee structures. So we'll break down the different types of fees. We'll talk about strategies to potentially help reduce those fees, as well as talk about the importance of having processes for fee analysis and fee review. And we'll even cover, of course, as we always do, some action items you can take away right away to start reviewing your plan fees and ways that we can certainly help you do that. So, with all that being said, let's jump right on in. Let's talk about the basics of 401k plan fees and fee structures. So there are three types of costs that go into a 401k plan fee structure. Those are your administrative fees, those are your investment fees, and those are your individual service fees. Each of these has their own way of being charged to the plan. They have their own breakdown. Administrative fees are costs that are, as they sound, related to the administration of the plan and the day-to-day functioning of the 401k plan. Investment fees, those are the fees that come off of the cost for the investments that plan participants pay for a particular investment option or an overall set of investment options that they choose to be invested in within the plan. And then individual service fees. These are the different types of fees that plan participants will pay if they decide to take a loan, for example. That's a pretty common fee that they'll pay. There's usually a charge for that setup of the loan and to administer that loan. And so the plan participant will pay that particular fee. With these different types of fees, they can be paid in different ways. So they could be what's called an asset-based charge, which is what participants pay for those particular fees for the plan and the administration of the plan. They can also be what I like to call hard dollar fees. Those are fees that the business can pay directly to the third-party administrator, for example, or directly to the record keeper to help offset some of those costs to the participants, as well as cover what the plan can't pay for out of the participant accounts. And then, you can have a combination of both of those, depending on how you want to run it. And in some cases, you can put, a majority, if not all of the costs under the assets under management umbrella, depending on how you have the plan set up. And so the other important thing to remember here is that ERISA provides for the importance of fee transparency. And so we advocate for making things as easy to understand as possible. So you're not trying to look at, a particular investment under the revenue sharing agreements or things like that to try to figure out exactly what the plan is paying. We prefer to have everything over here at Equity 401k Consultants to have everything set up as a specific line item for review and for ease of understanding for both plan sponsors and the participants. So let's break down the fees a little bit more. So administrative fees. Administrative fees are costs, as I mentioned, that, would be for record keeping, compliance to the plan, plan communications, things like that. A good example of that, of course, is your third-party administrative expenses that you pay every year. The cost for them to draw up the plan document or amend the plan document, cost for making sure that the annual testing is completed and the 5500 filing is done. These are administrative costs that are, paid directly to the third-party administrator. And investment fees kind of break down a little bit different. The investment fees you'll find in what's called the expense ratio of the particular investment option that is in the plan. Every investment has a different setup, right? So some of them could be passively managed, some of them can be actively managed, depending on the share class as well. That can determine what that expense ratio is. And so it's basically paid off of the returns that, those participants are getting. So let's just do a very easy example. Let's say a particular fund has a 0.5% expense ratio to it. If that fund earned 8%, after the 0.5 is taken off of it, it's now 7.5%. And you can generally see this, we cover this in the line items when we break down the overall plan costs, what the average expense cost is or expense ratio is, or the weighted expense ratio. That's how we can kind of break down that fee, and you can actually see what you're almost overall paying for the investment options in the plan. Again, the other one was individual service fees. These are fees for participant specific things. And we already kind of gave an example of that, but that would be a loan or a qualified domestic relationships order, a quadro. These are fees that participants are going to pay directly out of their account when they utilize those particular services. So if they take a loan, they're going to pay those fees. If they need a quadro, they're going to pay the fee for whatever that costs to get that done. That is not a fee that the business is going to pay because, again, those are individual service fees. And sometimes there's even, depending on the record keeper, there are annual or quarterly or sometimes monthly account fees that you can deduct from participant accounts. Now that we kind of have a good understanding of the three types of fees, let's talk a little bit about how to assess and compare those fees, because this is a super important part. I have found in my experience sitting down with plan sponsors, depending on when and how the plan was set up, the fee structure can obviously vary from plan to plan. It is not the same for every plan. And so what we want to do is every 3 to 5 years, it's very important that this gets done, that you benchmark the fees in the plan. So what we generally do in a plan benchmark is we will go out for a request for proposal from usually 3 record keepers plus the incumbent. We'll go out to 3 TPAs to get an idea of what the overall administrative costs would be for the plan, compliance cost to the plan. And then we'll do a benchmark of the investment options, looking at different things like performance, overall cost, what is, a good, reasonable expense cost overall for an investment menu. And then we'll put that all together in a nice spreadsheet and a nice report, looking at and a breakdown of all the different costs, as well as after that, we will dive in and make a recommendation for what we think the plan sponsor should do. Now, this is, of course, always up to the discretion of you, the plan sponsor. If you look at the information, you see everything and you think, well, these things are closer. Maybe we can make some changes here. Is there an opportunity that we could renegotiate fees with the current record keeper, make some different changes? Those things are certainly possible. And it will also help maybe save some of the time and effort that goes into making a move. Other times, maybe you have just outgrown the fee structure that you are in, and maybe it is time to make a change. And if that's the case, that will be in the plan benchmark along with the recommendation to do that. There are a lot of different tools that are available to you as the plan sponsor. The Department of Labor certainly has a lot of tools that you can go in and review things. You can use third parties to go out and get a plan benchmark. So TPAs can do this for you sometimes, depending on if that's a service that they offer. We offer it. We can do it as just a third-party project to your plan. So even if you don't want to change out your advisor, you don't want to change out the record keeper, you don't want to maybe make any changes to the TPA, but you want a unbiased third-party look, we can provide that service to you, and it doesn't, cost that much for you to be able to get that done. We'll provide it back. We'll provide a recommendation along with a full report, and you'll have the ability to take that back and take a look and see if it is worth making any meaningful changes at that time to the plan. Now, what we also want to discuss in relation to the plan is strategies for managing and lowering the overall cost. I kind of alluded to some there with the benchmarking process. In some cases, you can certainly go and renegotiate the costs that you're paying to your record keeper. You can sometimes even renegotiate your fee structure with the TPA, but generally, making that change might be a little bit harder. But, you can also definitely make a change that way. But the easiest sometimes is to go to the advisor, to go to the record keeper and make those specific changes by asking them to reprice or maybe negotiate those fees lower. And that can happen, especially if, you've hit certain thresholds. Maybe your plan has hit $1 million for the first time, or it's hit 5 million. You've hit these specific milestones where it is time to potentially look at renegotiating the fees. Maybe you have really good average account balances and you have a really good flow into the plan. And you've got that combination of, having a good asset amount and all those things that go into it. And now you've got a lot of ammunition to go and renegotiate the fee because you've done the plan benchmark and you can see what else is available to you. So exactly what you should be paying for the services that you're getting. Another thing you can do is in benchmarking the investments to help. Maybe the investment cost is really high because of revenue sharing or just a different type of share class that maybe you could get lower cost share classes in there, get rid of revenue sharing. That will help bring down the investment expense. And, even having a good mix of actively managed funds and passively managed index funds, that can help bring down your costs significantly. So those are some of the ways that you can help manage the overall cost of the plan. We certainly will go out and we can help you renegotiate fees as well and discuss those things. And the last thing that I want to end on, now that we've kind of reviewed the overall fees, we've reviewed what the fee structures look like, we've talked about what they are, the different, options that are paid out, how they're paid out. Now I want to discuss the compliance end of things. It's extremely important that fees are transparent. That's accomplished through the participant fee disclosure or the 404A5. And then for you as a plan sponsor, that's accomplished with your plan's fee disclosure, which is the 408B2 document. That will help explain all of the costs that you as the plan sponsor or the plan participants, however the fee structure is built, but that you guys are paying. It also will help break down each of the different components that are going where from the asset-based charges. So what the record keeping costs are, what the TPA share is, as well as what the advisor is charging to the plan too. All of these will help you disclose transparently what the fees are. And as a fiduciary, it's also important that you take into account and make sure that the fees are reasonable for the plan. ERISA doesn't have a requirement that the fees be as low as possible or they be at a certain place. They have kind of a very broad term, which, is reasonable. So what does reasonable mean when it comes to fees? Well, You kind of figure that out because when you benchmark the plan and you go out to market, you could see what other plans or providers or advisors or TPAs are charging for plans of your size. It's even possible to get the data for plans in your industry to see what they're paying based on what the record keepers and administrators and advisors are charging out there. Again, reasonableness is about understanding the fees and what you're getting for that service, and being prudent about understanding the reasonableness is having the processes in place so that you can demonstrate that the fees are reasonable for the services that you're receiving from all the different components of your 401k plan. Again, I always like to say thank you for taking the time to listen to me about 401k plans, especially what might seem like mundane topics or hard to understand topics like overall fees and fee structures. We always like to make sure that we provide some actionable steps at the end of these pods so that you can take away some value right away. And here's what I would suggest. Number one, if it's been a minute since you've actually sat down and looked at the fees that you're paying, at your next review, whether that's the next quarter or you're getting close to maybe your mid-year or annual review time, take the time during that review to look through the fees that you're paying. Understand them. Understand if there's revenue share going on. Understand what share classes you have and how that's affecting the overall investment cost. Look at what your asset-based charges are, or look at where you're paying some hard dollar cost for the different services that you're getting. Just take the time to review and understand those. And if you have questions, go through those with your plan advisor. Reach out to your record keeper to help them explain the cost, and even reach out to your third-party administrator to help them re-explain their costs and where they're at in pricing for things. That's number one. Number two is if it's been longer than 3 or 5 years, now's the time to benchmark the plan. And I know I say that a lot in this podcast, but benchmarking is so crucial to understanding whether your fees are reasonable, to understand what you're paying, to understand what's available to you in the market. And I think it is such a great step to do more often than not, every 3 years. But if it's been more than 5 years at this point, it is time to do that. And it's time to do that because you're missing a crucial component to being a prudent plan sponsor and meeting your fiduciary obligations. So do that right away. The last thing too is if it's been a minute since you've actually really looked at the investments, or you've actually taken the time to discuss with your advisor the investment options and their overall costs, take a look. I know I mentioned that the first step to do would be to review all the plan fees, and that's important, but it's also key that you understand the investment cost and the share class that you have, and really taking a look at that with a fine-tooth comb to make sure that your investment options are performing well and that they're also, reasonable for the type of investment. There could be an opportunity, especially if you have no revenue sharing going on in the plan, to really hone in on some of those costs, or maybe make some changes to the fund menu lineup, like maybe adding in some more index options that weren't available prior and just upping that. So take the time to do that. That's super key, super important, and a very valuable thing to do. With that said, I hope that this pod has been enlightening. I hope that it's maybe opened your eyes a bit to the different fee structures that are available to you. And that are out there, and understanding them a bit more. And as always, if you have questions, if you have concerns, feel free to give the office a call, shoot me an email, leave a comment on wherever you saw this, and we will be happy to reach back out and answer any of those questions. So thank you again. And I'm Mike Neely with Equity 401k Consultants, here to elevate your 401k plan experience. See you on the next pod.